David Keller is joining us once again to walk through some of his charts here. I love it, David, because you're starting off with gold. That's where I want to go first. And David is the Chief Market Strategist at stockcharts.com. So GLD, what are we seeing here?
Right, so with gold, you have this condition where it's become extremely overbought recently. And what that means is essentially, if you look at the price and then you look at the momentum in the form of RSI, the RSI went above 80. When the RSI gets above 70, we say it's overbought, meaning it's overextended, it's gone too high, too fast, but extremely overbought. When it goes above 80, that means that the momentum is so positive, we tend to call it the good momentum, meaning it's going to pull back probably in a little bit, but the momentum's so positive, you probably see a little bit of a further upside. We saw that over the summer. If you look back in June, July, you had that extreme overbought condition after the gap up in the GLD. The uptrend resumed, and I think we're starting to see a similar setup to what we saw in June and July, an extreme overbought condition. You'd expect a bit of a pullback, which maybe the last day or two we're starting to see that, but then you'd expect a little bit of a further upside, and that's what I'm sort of seeing going forward.
I love this chart because right now it's a really interesting setup when you overlay the chart to the fundamental story, because there was so much paranoia in the summer of last year about how bad things were going to get with the trade war, how bad things were going to get in the economy. And the fact that now this looks to be potentially setting up, as you described, to such powerful momentum that even a pullback leads to more. I mean, gold must be sniffing out something that is not being reflected in some of the other assets. How does it look next to the S&P? Because I know you've got relative strength on there as well.
Right. So I think one of the challenges you've seen with gold is if you look at September, October, November, the GLD gold pulling back, sort of having this slow and steady retracement of the previous gain. It pulled back to around a 38.2% sell-off, which is about right. That's a key Fibonacci level a lot of people pay attention to. And that's when it really underperformed. That's when the underperformance relative to the S&P really came out. But if you look since then, we've broken out of the trend line using the highs, which is the same thing we saw sort of in the second and third quarter of last year. That's when the relative strength started to improve once it became extremely overbought and emerged. So again, it's setting up in a very similar way where you'd potentially see some emerging outperformance. That would either speak to a lot of strength in gold or some potential weakness in stocks, and I think that's what we might expect more than anything.
Okay, now that's the relative component. What about when you look at the S&P 500 just on its own? Are we getting overbought yet? Are we getting that frothy on a technical basis?
So the challenge with the S&P, I guess not the challenge, but the positive read is that the uptrend has just continued unabated, right? And again, Charles Dow 100 plus years ago said an uptrend is a series of higher highs and higher lows, and the S&P continues to do so. And the leadership that we saw toward the last year was things like technology, semiconductors continuing to emerge in a place of strength in the new year, right? So overall, it's setting up very nicely. I think the challenge with the S&P is less an overbought condition, but it's also something like the breadth. So if you look at the percent of stocks in the S&P 500 above their 200-day moving average, it's just above 80%. It's about 81, 82%. And that is where it's tended to be when the market's topped out before. So if you look over the last 5 years, that's happened maybe 3 or 4 times. Every one of those times, there's been at least a little bit of a pullback, which is sort of what we saw maybe early 2017, or a much bigger pullback we saw at the beginning of 2018. We had sort of that more significant sell-off. So we're seeing a similar configuration now to when the market has been overextended, and expect a little bit of a pullback. And that just means there's so many stocks that are in a bullish configuration. And I did a screen yesterday on what percent of the S&P was trading above an upward sloping 200-day moving average. It was about 38%, or I'm sorry, 380 out of the 500 companies. So like 70 odd percent. So it was almost 4 out of 5 stocks were above an uprising 200-day moving average, which is very unusual and speaks to the frothiness that you suggested earlier.
So David, I feel like from the technical side, there's like 2 camps on that, where the one camp goes, hey, this thing's overextended. The other, and again, this is the most, the 200 that you're looking at was the companies trading above the 200 DMA is the most since 2018, that big frothy peak. That's pretty incredible. But again, to the point about the participation and those that are in these different measurements of strength, to me it sounds like you're interpreting that as, okay, a little bit too much, too fast, but don't others look at that and they go, hey, breadth, I love it.
Right. So that's the challenge, right? And that's where I think how you combine the two things I said. The market overall is strong. the uptrend continues. So when you're in that sort of uptrend, you have to mentally be in trend following mode until you see some sign of divergence, some sign of negativity. The trend is positive, and until you see something like the S&P or like the XLK start to trade below its most recent swing low, right? So instead of making higher lows, it starts to make a lower low of some sort. Until that happens, then the trend is positive. So what I look for any sort of guideposts, any sort of signals that might be a red flag that I'd want to pay attention to, and that is the one that emerges most recently. You're right. This means most stocks are in an uptrend. Isn't that what we want, right? Isn't that the fact that most stocks are up? But again, when it gets so polarized, when so many companies are in that same configuration, that usually suggests an exhaustion of buyers, because where's the new money going to come from? Where are the new buyers going to come in? The breadth is telling you that they're sort of all in and have pushed all of these names higher.
Yeah. All right. Let's talk tech here. It's been such an important component of keeping this market intact despite geopolitical headlines. XLK, let's go there next. How does that look to you?
So, one of the big questions going into this year, in my opinion, was, do we see a continue of the leadership themes that we saw in last year? And in 2019, tech, especially the large mega cap tech names, were certainly a huge theme. And when you have huge benchmark names like Apple and others that are continuing in such a solid uptrend, Microsoft's another one, they continue to impress, then big institutions have to be there because they have to have exposure to those big gainers. And that's sort of what we've seen at the beginning of the year now. Since Christmas, you've seen a resumption of that uptrend. The relative strength continues to make new highs. We did a look just yesterday at we have a proprietary technical rating using data on stock charts. And out of all the large cap universe, out of the top 10 rated stocks out of the entire universe, 7 out of the 10 are in technology and 5 out of the 10 are all semiconductor names. So when semiconductors do well as a big part of technology and as a sort of a bellwether of technology, the market tends to be in a pretty good place. So that concentration of strong technology charts, especially the mega cap names like Microsoft, like Apple, it tells you that the trend is positive. It tells you that the strength is there. And until you see a bit of a hiccup in the relative strength, which we have not seen yet, then overall it speaks to strength in the markets.
Yeah, really strong here, tech relative to the S&P. So we see just continues to pile up, even by our own standards of a market that's been driven by tech for so long. The last one is about rotation. This is one of my favorite subjects, David. Growth has come back with some pretty serious vengeance here since mid-November, basically. And you can look at this in a ton of different ways. You're using the ETFs IWF and IWD.
Right. So that growth value ratio has been really, really key. And I remember back in September, October, I was certainly saying, wow, this might be the end of the growth trade, right? And I'm always looking for themes that will catch people by surprise or catch people in the wrong positioning. And if you get into a situation where value starts to outperform, I think a lot of people are so used to growth names working like they have been that they'll be caught on the wrong side of it. You'd have to rotate over, and that rotation will cause an exaggeration of that outperformance by value. That did not continue, right? So the growth value ratio essentially didn't even break the 200-day moving average. It resumed higher. Wow. And then going into November, December, it's accelerated. So the IWF versus the IWD, sort of the traditional Russell 1000 growth and value indexes, at a new relative high here, new all-time high for the ratio, which speaks to the strength of growth stocks. And again, it fits very well with our previous chart looking at the XLK, some of those big growthy names. But also there are other ETFs that track pure growth and pure value. Those are also breaking out. So even if you look at the universes and really focus on growthy names versus value names by any measure, it speaks to the strength of growth. And again, there's no sign technically that's abating. It tells you that the growth trade at this point is still long and strong at the beginning of 2020.
Looking back at September, it's like that big drop in the ratio in the favor of value is just a hiccup along this trend. Really great perspective, David Keller. As always, appreciate it, sir. David is the Chief Market Strategist at StockCharts.com. Love it.